What's the best way to invest, passively or actively? On the one side are advocates of owning passively constructed, low cost, market cap weighted, own everything index funds. On the other side are advocates of owning funds in which managers actively apply judgment about what should and should not be in the portfolio and when. Maybe the debate is over. Maybe 2 decades or more of index funds showing higher compound growth rates than most of their actively managed counterparts have settled it. But maybe it's not so simple. Stay tuned as we review this debate, looking behind the top-line numbers to help you be a better investor right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani. Here we've got the team together again. I've got Adrian Nicholson and Erik Olson with us. Gentlemen, how was your Thanksgiving? Adrian, how was Thanksgiving for you?
It was great being able to spend time with my family. We were all just reminiscing about memories from the wedding. So that was a good time, getting great positive reviews. And we finally got the photos as well, and those all look great. So it's been a good time on my end. I've been really happy.
Oh man, that's great to hear that, Adrian. Rightfully so. And what a source of Thanksgiving. Yeah, fantastic. Yeah. We had a pretty small Thanksgiving itself, just my wife, my daughter, and myself. But Sunday had an interesting experience, which was in the afternoon we had a family of four members actually of a large family. Afghan refugees that came over and learned a lot about their saga of escaping from Afghanistan here when the evacuation occurred, and how life has been going since then, their journey through Qatar and New Jersey, and then ultimately here to West Michigan. So that was fantastic. How about yours, Roshan?
Oh, it was great. We had a great time. Erik, I have to ask, how did you meet this family?
My wife volunteers along with a number of other people from area churches doing English as a second language in some of the factories in the area. And so at this factory, it's mostly native Spanish speakers, but this factory has been hiring some of the refugees that have come in. And so it was just a very random thing that they got placed with her.
Oh, that's great. Now that's great. It must have been really interesting to hear their story.
Oh, it was. And it was also interesting because at 3:00, their alarm went off, and this app on their phone showed them where the direction was to Mecca. And so they rolled out a prayer mat and took some time to, go through one of the 5 daily prayer sessions. So it was really interesting at many, many levels.
Oh, that is cool. Now, my Thanksgiving was great. We do annual Thanksgiving football games, and this year the girls dominated. My niece caught the game-winning touchdown on Thursday, and on Sunday we only played a first team to 21, 3 touchdowns, because seems like a stretch to get the kids to concentrate for anything longer. But and on Sunday, my daughter got 2 of the 3 touchdowns in the on the game. So it was a fun Thanksgiving, dominated by the women on the football field.
Nice. I love competition, so that sounds like a lot of fun.
Yeah, it definitely was. It definitely was. Well, gentlemen, we've got a great topic today. We're going to talk about active versus passive investing. I think everyone will find it really, really useful to review this, understand it, figure out what they can do about this. Adrian, why don't you kick it off?
Yes, I'd be happy to. And these are 2 common investment strategies that tend to spark a lot of debate. You might be out there and there might be somebody that says, I have a really great strategy that I'm using right now. I just try and buy every stock out there, diversify as much as possible, and hold on to these for the long term. And that tends to lead them into the passive strategy. And then you might know somebody out there that's very active, where they're constantly trading or going in and out of stocks and just looking for ways to capture any type of discrepancy in prices or whatever it may be. And this will tend to be a more active approach. Maybe you're looking for something that's in between. So we're really going to look at these 2 different investment philosophies today, just to really see historically how they have performed and which ones might be something that you should be considering right now, because we know that this year has been a really tough environment for the market. So you might be looking at different alternatives and new ways to invest to see if you could have those better performance numbers in the next year or whenever it may be.
Adrian, I think this is an important topic for everyone, because to me, you've got to figure out from a behavioral finance perspective what's right for you, your personality type. There's also so much noise out there, whether it's TV shows, news articles, and depending on what approach you're going through, you may need to pay attention to some of these things. You may not, but it helps you eliminate so much of what's out there and focus on what's important to you and your strategy. So if I'm listening to this, what I'd hope to get from it is helping me figure out what's right for me as an investor. I think it's even more important in a down market, because I think that's when you really know who you are as an investor. So you can figure out, if I'm an active investor, can I stay the course? Or if I'm a passive investor, can I stay the course? Because there are pros and cons to both. And we're hoping to help everyone listening today figure out what's right for you, which pros line up to you as a person, and which cons are things you want to run away from.
Mhm. Yeah, so it's interesting debate. So let's talk about just in a little bit more detail what we mean by the terms for some of our listeners who may be thinking, you guys are using these terms active and passive like I should understand them. So let's just start with passive, because that's probably a little easier to understand. A passive investment is to say we're not going to try to outsmart the market. We're not going to sub-select some things and leave out other things in a market, or at least in an asset class. By an asset class, I mean all large companies in the United States, or all large companies in the United States that have really fast growth rates, or all large companies in the United States that are essentially priced at a lower price point relative to their earnings or their cash flows than other companies. Those asset classes, we will, instead of trying to sub-select, we'll just own them all. And typically the way this passive approach is expressed is by weighting those different things, not on an equal weight basis. So if you found 500 companies that are, you'd call the largest companies in the United States, instead of weighting them all at 1/5 of 1%, you would instead say, well, what's the largest of those 500, and how much of the 500 companies' overall market capitalization collectively does that one company represent? Then in my passive investment, I want to own a similar proportion or an identical proportion of my portfolio in that one company's stock. So a different way of expressing that is a market capitalization weighted fund. And typically these are just index funds. They don't take any sort of magic. And as a result, computers basically can run them and that are programmed properly. And as a result of that, they don't have a lot of overhead. And so they're able to make the expense ratios on those funds very, very wafer thin. Contrasting that would be active. Guys, you want to define that or talk about what that amounts to?
Well, active investing is a little bit more of a hands-on approach, right? With passive, you can buy and sort of forget about it. Here's where someone needs to be the portfolio manager. And to me, there's a huge range of what I'd call active. It could
Mm-hmm.
be as simple as buying individual stocks or bonds that you plan on holding for a long time, to the extreme of I'm trading every 5 seconds. Now, I don't. I think what we're discussing is today, and gentlemen, tell me if you have another direction, but it's more of the longer term buy and hold than it is the constant trading. I only bring up the constant trading because as I was preparing for today, I found that there were more articles out there about active being that frenetic trading approach. And I personally think that's just a sign of what's recently happened in the market. The fact that there was a lot of that going on, whether it was in stocks or in crypto, but the data shown that has slowed down a little bit. But going back to the most basic definition, you need someone to be the portfolio manager to select what you're buying and selling versus just getting the index and letting that run its course.
Great point. And then also the theories that go into both of these investment philosophy as well as something that's interesting, where mostly passive investors think that you really can't beat the market. Everything's priced in right now. You're better just diversifying and holding on to it. Whereas active investors are looking for those deals, saying markets aren't priced efficiently. If you do enough research and you get in at the right price, you can get some really great returns as well. So that's also something that really sparks debates between investors right now. If they can find those deals in the market, or is everything really priced in? And also just, it really depends on what kind of market environment you are into. So that's also a big area of this topic as well.
Mm-hmm. So I'm going to introduce a third category, because I think in some ways this is a bit of a false dichotomy, and particularly since a lot of the conversation or debate around active versus passive revolves around these ideological camps, where essentially one group is just adamantly ideological in their outlook and is really unwilling to entertain an opposite view, at least in its extreme forms. I think we have to acknowledge, just as you said, Roshan, that there's a lot of different ways in which active can be defined. And on top of that, I would introduce a third category that sort of spans these two polar extremes, or at least the way that they're characterized as polar extremes. And that would be to say, if passive says, yeah, just as you said, Adrian, there's no way to beat the market, so don't try. Instead, just minimize your costs as much as possible and hang on for dear life. If that's the passive view, and the active view is, what are you kidding? Actually, there's many ways in which we can identify this or that thing to own or not to own, for that matter. Sometimes it's just weeding out the bad that we see has a high likelihood of underperforming. An intermediate point between those is to say, let's own things in a very low cost framework, where we're not doing individual research on individual issues. We're just taking at a high level, a quantitative snapshot of the attributes of the things that we could own, and then eliminating those things that we have reason to believe those attributes are associated with underperformance in the long run. And we'll just leave the other things, the things that don't have those probabilistic underperformance attributes, we'll just leave the rest of those in the portfolio. An example of this in each of these would be on the passive side. And this is not advocating, by the way, none of these are recommendations. This is just an observation about what is. On the one extreme, we often associate Vanguard with the passive market capitalization weighted index fund. For what it's worth, just as an aside, they have a lot of active funds, and their active funds actually have done pretty well in comparison with their index funds. But nevertheless, if there's one company whose name comes to mind when we're talking about passive, it's Vanguard. At the other extreme, and I'm not, again, advocating this, I'm just noting it, another company that has a record of lots of active management would be, let's say, American funds, or possibly Fidelity. And then in the middle, you would have, using that, let's eliminate the things that are probabilistically bad, would be a company like Dimensional Fund Advisors, or DFA. They're on the one hand, they're market capitalization weighted indexers, but they also eliminate things that they view as not useful. We call that category, where it's more just using research principles to quantitatively eliminate things or incorporate others. There's various names for that, but one is maybe smart beta, or something along that line. Smart indexing, something. The various branding names have been thrown about for that, but at least at that level, we can expand the array of our conceptual categories, so we can have a more full conversation about what our options actually are.
Well, and Erik, just sort of playing devil's advocate here, wouldn't a passive investment purist call that just a different type of active management?
Yes, that's a great point. And I will say in response to the the person, the passive investor or the passive investing advocate who makes that accusation, or at least levels that charge, I would say, hey, do you own anything other than the global world portfolio of all assets? In other words, do you own every company from every country, every bit of real estate from every country, and every bit of every bond and commodity from every country on the planet in a market capitalization weighted manner? And the answer will almost inevitably be no. So what do you? Oh, I own
Let's just say
the
it's
S&P
the S&P
500.
500. Yeah.
Yeah. Oh, I would say, okay, you have now made an active bet. By eliminating, let's say, Mozambique and Sri Lanka from your portfolio, you have made an active bet. So you are, in that sense, at least, also guilty. If we're calling this guilt and innocence, you're guilty of precisely the same selectivity. You're just doing it as you're expressing that selectivity through the auspices of an index fund that is primarily U.S. large cap weighted.
I can see that. Although, to me, the difference, and I'm not necessarily. We'll get into opinions a little bit later. I'm not necessarily a passive guy, but to me, the difference between the S&P is you're just buying an index and you're not eliminating anything. Whereas when you add in the factors, you are eliminating things based on these pre-selected factors, right? When you're buying the S&P, your argument is, well, you're just buying the U.S. Okay, fine, but you're not you're making no selection of what's in there aside from whatever the S&P selects. Whereas if you're doing it factor weighted or smart beta, you're using characteristics of the companies to segregate them. That to me is probably the difference. You're not segregating companies based on any characteristics aside from index ownership.
Well, I'm going to push the point just a little bit then. So, because there are index funds that you can own and expressed as ETFs or as mutual funds that are indeed do have all the equities of all the world. And that's just equities. Now, I left out, of course, in that bonds, and I left out of that commodities, and on and on. I left out of that real estate. But if we're talking about, I would say, on that, just in terms of the philosophical aspect of this conversation, this is not advocating that you own all the countries of all the world, but there is an index known as the ACWI, All Country World Index, and there's actually a ticker symbol for an exchange traded fund with a ACWI that you can own, and that is accomplishing what I'm talking about, is owning all equities that are available on exchanges throughout the world in a market capitalization weighted way.
Well, so hold on. I don't think passive investing means you got to own everything, right? I think I guess that's where we differ, right? To me, passive investing means you're selecting an index that will select those holdings for you. Doesn't necessarily have to be the entire world index. It's just an index that that holds things for you. And I know there are indexes for everything now with the ETF world. I'm not really getting into that. It's just that you're not making any qualitative or quantitative differentiation between the holdings. You're saying, here's the index, I'm buying it. Whereas with the factors, you are making some differentiation of what you're going to buy and hold based on factors that apply to those companies.
It's probably a semantic difference, but I see your point,
Yeah.
and
I'm not against factor or pro passive. By the way, we're having the theoretical debate, I guess, right now, which we should probably move on from quickly.
Yes. So we've introduced the concept here then of thinking about this differently. One is getting down into the weeds and doing fundamental research and reading through reports and so forth. By the way, I'm not in any way critical of that approach, but that is what we commonly envision when we're talking about true active investing. Then at the other extreme, we've talked about passive, and in the middle, we're just using attribute or factor-based investing. But I would also say, if we look at the successes of just leaving out for the moment that intermediate position of what I have been calling smart beta, and just look at the difference between passive and active, the advocates of a passive approach have a strong basis for saying that, or strong evidence for saying that in most, if not all, of the major asset classes in which one could invest, there is a performance advantage long run to passive. And I can share some data about that if you'd like, but what are your sort of thoughts about that subject, the performance differences?
Yeah, not surprised to hear it. Let's actually go into some pros and cons, because I think, to me, that will explain away a lot of the difference. The
Mm-hmm.
first pro of pro of passive is ultra low fees.
Mm-hmm.
So to me, that performance gap will, at least in part, be attributable to active having higher fees. Right. So we'll go over
Agreed.
the data there, but that, just going over some of the pros and cons as you're thinking through what makes sense for you. And we're starting with passive. That, to me, is it's one of the biggest pros towards passive investor, is the low fees. Another big pro to
Well,
me
before you
is it's
leave that,
easy.
let's just actually let's just cite the fees, because you can now find, and this isn't true in every single asset class, but if you take large cap blend US, okay, so the S&P 500, let's say, you can find index funds, whether they're as a mutual fund or as an exchange traded fund, that are trading for 0.05% as their expense ratio.
Mhm.
Right. So in that level, it's at that level of the observable level of the expense ratio, it's extremely low. Whereas not all, but historically, mutual funds have come closer to being at about 1%. This is even the ones that are the quote unquote no load mutual funds. Some of them are 0.7, some 0.6, some
Well, I've got
0.5,
a
and so
data
forth.
point for you.
Yeah.
The Investment Company Institute
Mm-hmm.
says the average actively managed fund is 0.68, and
Mm-hmm.
the average passively managed, these are both equity funds, by the way,
Mm-hmm.
passively managed fund is 0.06.
Okay, so you're talking about 0.62 difference on average across all that. So that's right there, a cost hurdle that one has to overcome.
Or greater than 11 times, right? 0.06 to 0.68. That's
Mm-hmm.
greater than an 11 time fee
Mm-hmm.
differential.
Mm-hmm.
So
Mm-hmm. So
that's, go ahead.
yeah, go ahead.
I was just saying that's a big hurdle to jump when you're looking at some of these different categories.
Right. So to consistently beat that benchmark, if you will, or that index fund, you have to have your process of sub-selecting from that overall category. You have to have it outperform by at least 0.62% per year on a compound basis, just to tie the outcome net
Yeah.
of the expense ratio.
Correct. Yes.
Yeah. So, what are some other advantages, pros and cons?
Well, another one under passive is the transparency. You know what you have at all times, and
Mhm.
what's interesting is this could be considered a positive or negative depending on the perspective, right? So the positive side being, well, you know what you have at all times. For the passive investment, you can see what it is, look at the index, that's what you own. Whereas with the active, they will be making changes. So what you own does change over time. Now, the reason I said the perspective is important is because that's also one of the positives given to active, is the flexibility it has to shift, whether it's to different securities, whether it's to, in a down market like we have, whether it means they're able to, raise some cash versus, getting out of stocks. So that flexibility is the positive side of active, but the negative is, if you want to know what you have at all times, that won't necessarily be the case with active.
Mhm.
And when I say what
Mhm.
you have at all times, just to be clear, within the mutual fund, their individual holdings, those individual holdings will change. So you still own the same fund or ETF, whatever you may have, but the holdings within them can change.
Mhm.
And as I was mentioning, the going to cash, that's also another advantage to the active investing, is they have the ability to hedge or make adjustments. Whereas the passive, you're just going to own it. One of the you had mentioned Vanguard earlier. They had the first index fund, their 500 index fund. Well, that just shifts once a year, right? So, and that usually there are additions and subtractions, but the majority of it is just getting true to the target percentage that they want to own, as opposed to additions and subtractions. So I said they're there, but that's not the major change.
Mhm.
Another positive, and once again, this is a great one for them from the perspective. A positive towards passive is it's tax efficient. You typically own that holding for a long time. The holdings within the portfolio, as I said, you own for a long time. They just reshuffle once a year, so it is tax efficient. What you lose to that tax efficiency is tax management, which is a pro towards active, where they can look at the market. And we talked about tax loss harvesting on our episode last week. That's an active management type decision you make, where with the passive of just buy and hold the index, you're not making that kind of decision. And gentlemen, I'll give you a couple of disadvantages of passive. They're limited to what they own because they typically just own the index. Another one is their return will typically be that of the index less the management fee. Where you counter that with active, and we're going to go through the data about how many outperform versus don't, but there's a possibility of outperforming in the active space that you don't have in the passive space. Whereas in the passive space, you're going to get the index minus the expense ratio that you're paying. Now, the counter to that, positive on the active side, you can potentially outperform. The counter to that, the negative, is there's active risk, right? If the manager is wrong with whatever decision they make, whether that's this holding, they think this is a good holding, but it underperforms the market, or they hedge the portfolio and the markets turn up, there is a risk that the active manager is just incorrect in their active decision.
That's a good list, Roshan. And I got to imagine, just for our listeners and viewers, these advantages and disadvantages for passive and active can be some make or break deal for some people, just because of the behavioral aspect of it as well. You might feel like you're somebody that is really towards passive investing, buying and holding, but if you're in a market environment where everything's going down, you can find yourself really concerned at the end of the day, where you see your portfolio dropping, where if you had that built-in flexibility and those hedges that some active strategies do had, you could have really protected your way on the downside. And also another thing that you point out as well, the tax implications as well. I know that's something that a lot of people really want to focus on when it comes to their investments, how to be as tax efficient as possible. So those are all really things that people just need to consider to see which ones will be best for their situation. And I really think the blending aspect of it is really well, where you really need to have also a set of principles as well. That's really important, because you don't want to find yourself just jumping from one strategy to the next, because if you're in a market environment that's really having some up and down swings, you can just find yourself just chasing performance. So having some built-in principles can really help you when you're really considering or just making an ultimate decision on, I'm a passive investor, an active investor. Having built-in principles really will help you out in the long run when it comes to investing.
Yeah, as our intent with this was to give people information on this debate, because there's a lot of talk about it, and try to help you make a decision. As we're going through this, I'm thinking of some of my clients that say, Roshan, I just like you to deal with it, because there's so much out there, and this to me is one of the more basic concepts, but there really is so much out there for you to figure out what's right for you. As well, as we always mention, we're there to help if you've got questions or need help making the right decision for you. Erik, you've got some good data that you have prepared
Yeah.
to share on the performance of active versus passive.
Right. So let me go ahead and pull this up, and we'll take a peek at this set of documents, or set of charts at least. So let's actually start with this chart. And so for our listener, not our viewer, listener, we'll have this in the show notes, this report. It's actually the two tables that I'm going to show you here are from the most recent version of report that Morningstar produces. I think it's a couple times each year, which is looking at this question of active versus passive approaches. And this is a much, much more detailed report than the two charts that I'm about to show. But nevertheless, you might want to pursue it. We'll have a link to that in the show notes, and so you'll be able to obtain that yourself. But for our listener, then, who I'll explain what our viewers are seeing here. This is a table that shows on the left-hand column a number of different asset classes in which one might invest. So here there are 20 different asset classes. And alongside those, then, are columns looking at the percentage of the actively managed funds in each of those asset classes. Again, large blend, large value, large growth, mid blend, mid value, mid growth, and so forth, all the way down through international and bond types and real estate and so forth. It's looking at what percentage of those actively managed funds beat their index or beat their category at least on some trailing basis. In the first case, on a trailing 1 year basis, on the trailing 3 year, 5 year, 10 year, 15 and 20 year basis. The numbers, let's focus on the 10th year. It is interesting that in probably the most egregious example of really, really poor performance is that on a 10-year basis, the actively managed funds in the mid-cap value space, only 3% of all of those funds outperformed the index over that 10-year period. That's a very powerful indictment of the active management approach in that category. And in that, oppositely, then a very strong endorsement of what would be a passive approach for that category. But what I also want to highlight is that if you look down the page, while it is undeniably the case that the minority of active funds in these categories will, over a 10-year period, have beaten their index, it is, if you look in the far right two columns, important to make the distinction as to getting in under the hood of all of those actively managed funds to further segment them. And so if we were to segment the active funds into another element of one of the pros that you cited, Roshan, for a passive approach, here, when we look at the active funds that have a low cost structure, the lowest decile of costs as their underlying expense ratio, then the picture changes somewhat. It's almost without exception the case that the high cost ones, the highest cost decile of actively managed funds, are just completely blown away by passive. Not in all cases, but in most. But here, this is just illustrating that a large portion of the explanation for all of this is the cost factor. I'll augment this by saying that what you see in particular is that in some categories, this isn't true. A low-cost, actively managed fund over the last decade in, let's say, the area of selecting companies that are based in Europe, a European stock selection model, an active approach has worked much more effectively there than is true in the U.S., for example. It's also the case that intermediate core bonds over that decade, the lowest decile actively managed funds have beaten the index by a margin, and certainly even more so in the case of high yield bonds. But I think most people who would look at this table would say, wow, even on that basis, it seems like it's very, very persuasive that you should just stick with passive, because there are only a few areas where even low cost actively managed funds have modestly outperformed. And I would say that's one conclusion that you could draw. I'm going to challenge that conclusion in just a moment by also, but first I want to look at this second table. So this is, again, looking at 10-year returns. And without getting too deep into the weeds on this particular table, it's again looking at these 20 asset classes that Morningstar has incorporated into this report. And what I would just want to say is look to the right edge of this table and look down into the second column in from the right edge, go down to the bond section, what you see here is that the larger funds, that would be asset weighted measurements of this entire category, larger funds in the bond area tend to outperform the passive, the passive funds. Their 10-year returns,
Hold on,
for
Erik. I
example.
want to interrupt just to explain a little bit further. We're looking at the difference between passive and active returns.
Mm-hmm,
A negative number means active outperformed passive.
mm-hmm.
So on this bond section, you're seeing a negative 0.3%, which means that an active bond fund outperformed the passive bond fund by about 0.3%.
Mm-hmm. Yes. And a high yield bond fund, actively managed high yield bond fund. Again, this is now not segmenting down to the lowest cost ones. This is taking all of them. The actively managed high yield bond fund, especially the largest ones out there, because that's what the asset weighted study here is taking into account. The largest high yield bond funds outperform the largest passive high yield bond funds by about 0.8% per year over this 10-year period. What I think is also important to say, though, about both of these tables is all of the asset classes that are not shown here. My criticism of this particular approach, and I'm not, by the way, just to say, as an advisor in clients' portfolios, we have passive instruments, we have active instruments, we have factor-based smart beta instruments, we have private equity, private debt, we have an entire range. So if you look at the sorts of things that we incorporate in clients' portfolios, I'm not an ideologue. It's a very eclectic approach. But I do get frustrated at times with the ideological champions of these various approaches, when in some cases, just by the way in which the data are framed, it creates this appearance as though hands down one or the other camp is winning. I would say, for example, in this category, what asset classes do you not see here? Well, for example, you don't see convertible bonds. You don't see tactical approaches, which by definition I would say are either smart beta or active, but they're nevertheless, they are categories of investment in which you may want to invest. We're not seeing commodity approaches here. So if you isolate to those asset classes where it's possible to implement a passive strategy, then in many cases, yes, that might make sense. But let's not leave out the fact that there are many useful asset classes one can include in a portfolio that don't lend themselves to a passive approach. Nevertheless, they add a lot of value to the portfolio overall.
Yeah, I agree with you. The other thing on that first chart was it only went back 10 years, correct?
Well, that one went back as far as 20, but many of the categories, the 20 asset classes that they showed, don't have representative membership 20 years ago.
Yeah. So I just wonder with the time frame, even going back 20 years, the majority of that time frame is when we've had these really low interest rates. So I would just wonder if the data is a little skewed.
Oh, well, see, that was another thing that I was going. I'm glad you raised that, because our dear listener, if you think back over what's taken place since 2009, when the Federal Reserve put interest rates at about zero and kept them there for the most part, with a bit of a wiggle, I think it was in 2017, 2018, and then, pardon me again, now more recently. But if you look at what is what the impact of those uber low or essentially zero interest rate policies were, what does that favor? That favors super large tech companies that are borrowing money for next to nothing and then redeploying that in expanding their businesses. And when you take that punch bowl of super low interest rates away, what happens? Well, as we've seen since that's been unfolding here, it's been the largest, most extremely, I would say, very high valuations on those companies, those have been the companies that have seen the steepest descents in all of this. And actually, the companies that have been strong fundamental companies, didn't rely on cheap borrowing to make the model work, that are paying dividends and so forth, those companies as a group have held up extremely well here. So what is just, in other words, the chart that we were looking at isn't just some sort of universal statement about all time. It overlays this period where, if anything, large cap borrowers, high growth companies have been favored. And those companies, if you think about the most pronounced ones, Roshan, earlier in our pre-show conversation together as your co-host, we talked about the FanMag stocks. FanMag stands for Facebook, Apple, Netflix, Microsoft, Amazon, and Google. When you take those 6 stocks out of the index and you look at how has the rest of that universe of stocks performed during that period of uber low interest rates, it hasn't been anywhere near that performance. So low interest rates, I will just say, have it. The thesis I'm advancing here is that, and that building on Roshan's point, is that significantly has distorted those results on a 10-year trailing basis or 15-year trailing basis to favor passive strategies.
Yeah, it definitely has. Now, getting back to the point of the last point, how to choose what's best for you. So, if you're an investor, gentlemen, here's what I would share, and then I'd love your thoughts on it. First is, what works for you as an individual or personality type, right? Are you someone who wants to set it and forget it, or are you someone that wants to either be doing research and looking for investments yourself, or having someone doing that on your behalf? Right? What makes sense for you personality wise? And what are you comfortable with? When the market goes down as it has in 2022, are you comfortable saying, "Well, I own the index, so everything's gone down, everything's gonna come back up"? Or are you someone that needs to say, "Well, I own this company; it's a good company, and I'm sure it'll recover"? What makes you feel more comfortable in this kind of down market? I think those are the questions that you look at, amongst others I'm sure you'll both have when you're looking at this decision. But to me, it's not just, it's behavioral finance, figuring out what you're comfortable with. It's then execution and the noise thing I mentioned. How would you execute on one strategy versus the other? And then third, when you're tested, what would you be most comfortable holding through a down market? Any other points that either of you would add in deciding what strategy is right for you?
Yeah, I would say if you believe that it's possible, since all of the things that we were looking at a moment ago were on averages in those categories, or in the one instance where we went aside from the average, we made distinctions about the upper and lowest, the highest and lowest decile of cost. So there we did sub-select into the actively managed camps in each of those asset classes. But beyond that, if your view is it's impossible to reliably identify active managers who will have a sustained record of outperformance, then of course you would want to be favoring a passive approach. But if you think it is possible to identify, instead of saying I'm going to own, I just, my aspiration in life is to own the average actively managed fund. Instead, my aspiration as an investor is to find those managers that have a sustained record of outperformance. Then you might say, then I will include some of those actively managed approaches, especially in the asset classes where they have an edge, in my portfolio rather than using a passive strategy. And then the other big criterion that I would use is, if you have some very specific set of values criteria that you want to see expressed in your portfolio, either things you want to avoid or things that you want to ensure are indeed part of your portfolio mix, it's easier to do that. Not impossible to do that with passive, but it's substantially easier to do that with actively managed funds, where you find fund managers who share those convictions and then are actively excluding some things and deliberately including other things that are on alignment with that values base.
It's another great point. If you've got, we have a client we work with that wants to invest in primarily uh, female-led companies,
Hmm.
and that's something that just wouldn't line up with a passive approach.
Hmm.
You can't focus like that. So yes, definitely from a values-based perspective, it does make it more complicated. There are indexes out there in that space for the more values-based approach, assuming you're comfortable with what's in those indexes.
Hmm.
But to get something really customized towards you, you almost can't go that passive route.
Hmm. Yeah, the big development over the last 4 or 5 years has been this category known as environmental, social, and governance criteria, or ESG criteria. And in some cases that's legitimate, that the managers of those passive tools have said they're mostly passive. We're just applying these filters to filter out and filter in, but otherwise it's a passive index. Unfortunately, what we found as more and more sort of close research has been done on some of these things, what is not always, but too often the case, is that it's what we would call greenwashing. By that I mean, here, we know that you're looking for something that makes you feel good about investing in a more environmentally friendly way, and so we're going to just call our fund ESG, and that'll help you identify it, and then you'll be more likely to invest in it. Great. You get into the weeds and look at what they actually own, and you sometimes go, oh really? Doesn't really match the marketing.
It's very, very true. I've seen that. I've gone through lists of holdings with clients before that were looking for something like that,
Mhm.
and they had said it, even though they're called that, because they usually have criteria to determine what holdings are in there, but then they just didn't personally agree with what was in there.
Mhm.
So I can see that for sure, where you've got to go that more active versus the passive route.
Yeah, the
Mhm.
last one I'll mention is just risk adjusted return. That's a pretty important concept here. Just I know some people maybe just want to try and just knock it out of the park sometimes, but you have to also look at the other end of that. Are you willing to also accept some of the downside? Just how much risk are you willing to take on for that return you will receive? Because it's going to be different depending on what fund you're in, what asset class you're in, what strategy you're using. Just look at that before you maybe jump to one to another. Just it always comes down to your individual situation. So just looking at what are the downside as long as the upsides with a certain strategy or investment always helps out.
Excellent. I think we covered the topic well today. Hopefully, for everyone listening, this will help you in deciding what makes sense for you as an investor. Uh, Thanks for joining us. We'll be back next week with another great episode. Please like, subscribe, give us 5 stars, tell your friends and family. This has been another episode of the Retirement Lifestyle Show.